Okay, so chapter 22 gets into budgeting. I know what you're thinking. I already know how to budget because budgeting is easy, right? Um, so this is kind of like the budget you would have if you were doing a home budget or something like that, but of course it's for a business, so it's broader based. Anyway, so let's just kind of jump into it and look at it. So the entire point of budgeting, both if you do it for your home or if you're doing it for a business, is so that you can establish goals, execute those goals, and then compare your actual results with your goals, right? And then make adjustments. Think about if you make a budget for your house, it's not going to work out perfect. You have all your living expenses as a student, and you have to pay your rent and pay for food, and and sometimes you come up short. Occasionally you actually have a little extra left over at the end of the month. Probably not. Usually it's the other way around, where you're short, and so then you have to make adjustments, right? One of the things we always used to do when we were young is we would be like, well, we can't afford to eat out, so let's not put that in the budget. We just won't eat out. And then guess what happens? Occasionally you eat out because it's just convenient and it's nice to not have to cook sometimes. And so we started saying like, okay, we have to be honest with the fact that some of the things that we shouldn't do that much, we should plan for them because we know we're going to, right? So this is why we budget: to establish goals, execute those goals, and then compare actuals with goals. So the terms they use in business for this are planning, directing, and controlling. And you'll see that in other classes. But this is the function not only of managers, but also of budgets: to make a plan, direct that plan, in other words, make it happen, and then control it, which means compare actuals to the plan, and then that provides feedback for continued planning. Okay, this is what we do. This is a big part of what managers do in businesses, and managerial accountants are part of that team. So this is a kind of budget you probably have seen. This is called a static budget. It means you just, in essence, are going to, your managers and saying, well, how much do you think we're going to be paying in direct labor? And they base that on some experience, right? And so you just make this budget for the department. Usually what they do in a large organization is they have each department do a department budget, and then that gets passed up to the division level, and the division will kind of take all those department budgets and turn them into a division budget, and then that gets passed up to the, whatever the next unit of business is, until they have an entire budget for the whole business. Okay, this is pretty much what we do here at EAC. But our new accountants, we just got new accountants a couple years ago because our old controller became the vice president of operations for the college, and so they're trying to move us to away from a static budget and onto a more flexible type budget. So for a manufacturer, a flexible budget looks kind of like this. It will just do kind of what the static budget looks like, but it will do it for various levels of production. And so that way we can kind of compare our actuals to 2 or 3 different budgets. Okay, so you can see it. If we're going by units of production, we could say, well, what would our budget look like if we produced 8,000 units, or if we produced 9,000 units, or if we produced 10,000 units? I used to do the same for my storage business. We're not a manufacturer, but I would say, what would my budget look like if I was 60% occupied, if I was 75% occupied, if I was 90% occupied, right? That way I could compare my actuals to various levels of potential production. So you'll see the variable costs change with the units of production, the fixed costs don't. So that's a flexible budget. So this kind of gives you an idea, I guess, in a picture format. They have their static budget, where you just have the budget versus the actual results, versus the flexible budget, where you can say, okay, because here we don't know, is this variance or being over budget, is that because we actually produced more units than we planned for, or was it because we just didn't manage our costs well? Here we can say, okay, well, now we know the actual number of units, so we know which budget to compare it to, and we can see if we actually produce 10,000 units, then we're actually under budget for what we should be for 10,000 units. So that's the why we do a flexible budget, so that we can compare to the actual number of units produced. So most organizations have something called a master budget. And it's what it sounds like. It's this overarching giant gargantuan budget for the whole organization. And again, it comes from the various units. So here at the college, our basic unit is called a department. And so if you see, and departments are actually broken down by course prefix. So this course has a BUA prefix. That's a business administration department budget, okay? If you take a course with an SBM prefix, small business management, that's a separate department. Because of this though, many of our departments are like one person departments, and so it's weird. But so there's a budget for each one of those. So as a division chair, so I'm responsible for all departments in BUA, BUS, SBM, CMP, FCR, COE, COS, cosmetology, somehow I got that one. FCR is Family and Consumer Resources, so quilting and stuff. I'm responsible for that. Am I missing? Oh, and now we've just created CIS, Computer Information Systems. So I'm responsible for all those departments. And so I have budgets for each of those. Okay, so for each one of those, I have to say, okay, here's what our costs are going to be. And we don't deal with revenue so much. So I'd be more of what's called a cost center. I just have to manage my costs. I can't really control revenue. We can a little, right? Get more students into the program, that'll increase our revenue. So that's the sort of process, okay? So master budgets are made up of operating budgets and financial budgets. The operating budgets are the sales budget. How much do we think we're going to sell? The cost of goods sold budget. How much is it going to cost us to either make or buy the stuff we're selling? And the cost of goods sold budget is going to be made up of the production budget, direct materials purchases, direct labor cost, and factory overhead. Not a surprise. Those are the things that go into cost of goods sold. And then the selling and administrative expense budget. The financial budgets are going to be the cash budget. How much money do we think we're going to collect versus how much we're going to pay out? And capital expenditures. What's the big equipment needs and stuff like that we're going to buy? So with all of this, we can create a budgeted income statement, what we think the income statement's going to look like, okay, or what we're planning for it to look like. And then with the financial budgets, we can also create a budgeted balance sheet. And the cash budget, if you think about it, is sort of a budgeted statement of cash flows. So recognize, just because we think we're going to sell stuff doesn't mean we think we're going to collect all of those sales in cash during this financial period, right? And probably we're going to be collecting some cash that was from sales in the last period. So that's why the cash budget will often look different than the sales budget. So we kind of have to produce these in a certain order to make it all work. We have to start with a sales budget, because the sales budget will tell us how much stuff we think we're going to sell. And we need that before we can go to the production budget, because we have to know how much we think we're going to sell before we can budget how much we think we're going to need to buy in direct materials and how much direct labor we're going to have to put into that. We need our production budget is made up of direct materials, direct labor, and factory overhead. And then all of that will flow into the cost of goods sold budget. And then we can't produce this budgeted income statement until all of this other work's done. Okay, so they have to be done in this order. And so that's kind of what this whole chapter is about. So the sales budget. You'll see a lot of these will say like slide 2 of 3. That's because I cut out slides. Whoever produced this slide deck, they like to first have a slide that's just all text that explains to you what it's going to be, and then one with like an example on it. And it gets kind of overwhelming. There's like 90 slides or something. So you'll notice I've trimmed some out, okay? So they have this company that produces wallets and handbags, and we'll kind of carry through as we look at some of the examples. And so honestly, in real life, you would just be going to your sales managers and saying, based on last year's sales and based on the market, I need you to give me an estimate of what you think sales are going to be in the next year. That's pretty imperfect, right? Yeah, you're just hoping that they're right. That's not, you know, and there could be reasons why that would change, and some of them are within control and some of them aren't. But so you come up with those numbers, and so honestly, that's, I mean, that's it. So in a problem, it's just going to have to tell you that. It's going to say, you know, they think that in the East sales division, they're going to sell 287,000, in the West 241,000. We can take the total volume times the price, and we can come up with a total sales. Same with handbags. So again, in a problem, it's just going to have to tell you that. In real life, you're leveraging and leaning on the expertise of your sales staff, your sales people. So that's all. The sales budget is just how much stuff you're going to sell and at what price you're going to sell it to get a total sales amount. Okay. So to do a production budget, we need to figure out how much stuff we're going to have to produce to manufacture to meet the needs of those sales, right? So we have to adjust that for the fact that we usually want to leave some units in ending inventory going into the next financial period. So we take our expected units to be sold and add any desired ending units in ending inventory. And then we subtract any estimated units in beginning inventory, and that will tell us how much we need to produce during the period. Okay, so that's the first step in creating the production budget, is to say, they've just told me how much we plan to sell. So how much do I plan to sell plus how much do I want left over when I'm done, minus the amount I already have on hand, will tell me how much I need to produce. So for this one, elite accessories, you know, there's the data we need. So we'll have our expected units to be sold, plus our desired ending inventory gives us our total units available, minus what we already have, tells us the amount to be produced. Again, this isn't rocket science, but there is a lot of moving parts, so it can get confusing. So that pattern, have you noticed that pattern throughout this whole course, really, of like what I have, you know, plus what I want to have left over, minus what I have at the end, you know, like we keep seeing that over and over. Okay, so there's our production budget. They're going to produce 520,000 wallets and 292,000 handbags. Once you know how many of those you're going to produce, now you can start to make a budget for the direct materials you're going to need to actually make them, and for the direct labor you're going to need to make them, right? So again, not crazy hard. I will tell you, if you try to look at a master budget like as a big thing, it can become overwhelming. If you break it down piece by piece and in order, it's pretty manageable. You know, a lot of things are like that in life. Like if you were, that's why it's a good thing you raised children over 18 years, because if you were like to just like think about what it would mean to parent a child, like nobody would have children, right? The species would die out. Instead, you just sort of get along day by day and do the best you can. All right. So direct materials purchase budget. Step one, we figure out the budgeted direct material required for production. That's pretty easy. We say, well, we're going to produce this many units. We need this much direct material per unit, multiply it out. That's the amount of direct materials we need for production. Okay. Step two, the budgeted materials required for production is adjusted again for beginning and ending inventories. So the materials required, add in the desired ending material, gives us the estimated beginning materials inventory, subtract out the amount. Oh, I'm sorry, subtract out the amount that we already have in inventory will tell us the amount we need to purchase. Same process. Step three, we just compute that. Budgeted direct material equals the direct material quantity to be purchased by the unit price. So again, so they're just following this whole process. For wallets, we need this many square yards for production. For handbags, this many square yards. We add the desired ending inventory to get the total yards available. Subtract out the estimated, I'm sorry, the desired ending inventory. We subtract out the current inventory, and that tells us the amount to purchase. Multiply that by the unit price. That tells us how much we're going to spend on direct materials. Again, step by step, it's pretty simple. Viewed too broadly, it gets overwhelming. Here's what's interesting about how this and how our brains work. My wife, she's the artist, her brain short circuits with stuff like this. She's super smart, but this like overwhelms her brain. And for me, these like line by line things really work well for my brain. Flop it and I go watch her, and she's got an entire wall. I don't know, you've seen what she's done in like Safford High School gym, you know, so 70 feet by 20 feet. And she can create a vision in her mind of what that will look like and sketch that out and then put it on the wall. And that's overwhelming to my brain. I'm like, I wouldn't even know how to start with that. So it's funny, you would think it'd be the same skill set, but it's not for some reason. So don't ever discount someone for whom like accounting is hard, is what I'm saying, is because it's a specific set of skills. Your brain works in a different way. Yeah, never discount a woman who can throw a javelin 150 feet. It means it's going to take you a while to get out of her kill zone. All right. So that's our direct materials purchases budget. Mm-hmm. Yeah. So usually as part of your planning, you're saying like, you know, we want to have either a certain amount of material still there, or a lot of times it's a certain percentage of what we think our production is going to be. You know, we want to always have a little extra. All right, direct labor budget. Again, step one, determine the budgeted direct labor hours required for production. Budgeted direct labor volume times direct material quantity, or however you do it. In this one, what they're saying is for each unit we produce, it takes this many hours, a half an hour, or whatever it is. Okay. So in a problem, it's going to tell you something like that. Each unit takes, you know, 0.3 hours to produce. And then you just multiply that by the number of units you're going to produce. Other companies do it by the direct material. So for every pound of direct materials that are processed, it takes, you know, 0.2 hours or something like that. Step two, determine the total direct labor cost as follows: direct labor required for the production times an hourly rate. So their wallets, they have two different processes. Cutting and sewing takes those hours. The handbag takes so many hours. That's their total times their hourly rate, tells them their direct labor costs. Step by step. Factory overhead budget. We add up all the factory overhead. Again, in a problem, it's just going to have to tell you all this information. Okay. And what's nice about this is we're not worried about allocating it because we're just doing the budget for the overall. Okay. All right. So now this starts to like, whoa, that's a lot. But here's our cost of goods sold budget. Starts with our finished goods inventory. Then we have our work in process inventory. We have our direct materials, what we have on hand, plus the direct materials purchases from the budget we just made. Okay. Gives us the cost of direct materials available for use, minus our ending or our beginning direct materials, gives us the cost of direct materials placed in production. At our direct labor, at our factory overhead, gives us our total manufacturing costs. Add that to our work in process, gives us our total work in process during the period. Subtract out our ending work in process, gives us the cost of goods manufactured. That plus our previous finished goods budget gives us our cost of goods available for sale. Then we take our finished goods inventory, the end, and that gives us the cost of goods sold. So we've done this before. Okay, this is just a projected version of it. I know it seems like a lot. The hardest part actually in Cengage is like figuring out which line item they want from you in each line item, right? But as far as the process of it, this is not new. It's just kind of bringing it all together. Uh-huh. Right. Right. Because if it's left, then it's not part of our cost of goods sold. So these are the goods we had available for sale. This is what's still there, or what we're budgeting to still be there at the end of the period. So this is the total of our cost of goods sold. Again, it's an estimate. So this is the whole process of building the sort of plan, the budget. Then at the end of the period, we're going to compare it, right? And be like, well, how did we do? Did we match up to this budget? If we were off, why were we off? What can we do about it? It would be given to you in the problem. In real life, it's just an estimate. Something like, we expect sales in the next period to be this amount, and so we want to make sure we have an ending inventory of at least 30% of that sales, or something like that. That's how it happens in real life. The idea is you never want to be fully out of inventory. You always want to plan to have some inventory on hand so that you can meet demand as you're producing more. So this is just an estimate. As opposed to on a real schedule of cost of goods sold, it would be a physical count, right? You would actually count how much stuff was there. But on a budget, you're just saying our plan is to leave 1.565 million in inventory at the end of the period. So in a problem, it would just have to be given to you. So a selling and administrative expense budget, not a lot of figuring there. It just has to sort of tell you the items and you have to plug them into the budget. Okay. So then you have all the information you would need to do a budgeted income statement. Your revenue is going to come from your sales budget. Cost of goods sold is going to come from your cost of goods sold budget. Revenue minus cost of goods sold gives you gross profit. Selling and administrative expenses going to come from your selling and administrative expense budget. It's going to give you operating income. Then it would have to give you this information. And so again, a lot of this chapter is just knowing where to plug things in on these statements. What I would recommend is, as you're doing the homework, be comfortable going to those pages in the ebook to see how they have it laid out, right? Because that's where you're going to be like, I don't remember exactly how this was laid out. A schedule of collections from sales. So now we're getting into recognizing that even though we made a certain amount of sales in a month, we don't always collect all of the sales in that month, and sometimes they get collected in future months. So this business has cash collected from prior month sales, cash collected from current month sales, and then total receipts. So this is the cash budget that we're starting to work on, is how much cash we actually collected each month. Usually the way they'll lay these out in a problem is it will tell you something like, here's our budgeted sales for these 3 months, and we project that 60% of sales will be collected in the month they're made, and 30% will be collected in the month after they were made, and 10% will be collected 2 months after they were made. And then you have to like build this out that way. Okay. But in real life, again, we're just estimating. We would do it the same way, but we would have some historical information, right? Saying on average, we collect this much in the month of sale, and so forth. Same thing with payments for manufacturing costs. We recognize that we will pay many of our manufacturing costs in the month they're incurred, but others we might not be paying till the next month because our supplier gives us payment terms or something like that. So same idea. In a problem, it's going to tell you something like 25% of the previous month's manufacturing costs get paid during this month, plus 75% of the current months. And so again, you take the total and then you just apply that 25% times the total of last month's costs plus 75% of this month's costs. And that's how you come out with it. Okay. So again, and when we do a guided problem, we'll see that process, right? Of how we. So then your cash budget is going to have your collections from accounts receivable. Then there's an additional cash that comes in that's not part of operations. These are your total cash receipts. your manufacturing costs minus your selling and administrative expenses, which were on our selling administrative expense budget. Capital additions, that would have to be given to us as separate information. Interest expense, income taxes, again, given to us as separate. Total cash payments. Then for each month, we'll have either a cash increase or a cash decrease, and so forth. Okay. So again, the key to this chapter is don't let yourself get pulled into thinking broader, think narrow, do it step by step by step, and it's pretty doable. Capital expenditure budget. This is money spent on long-term assets, okay? So again, this is just gonna have to be information that's given to you. So it's kind of like I do my annual budget here at the college, but then every 4 years I have to replace these computers that are here in the lab. So I don't budget for them every year, but on every 4th year, I have to do a capital expenditures budget and say, I'm gonna replace all these computers. And then like every 8 years, I have to replace this whole mediation system. Like this summer, all of these projectors and stuff will go away and we'll go to TVs like we have in that room. And so I have to do a special budget for when I have those big ticket items like that. It cost me 248 grand to replace all of these computers in this building last year. I'm glad it wasn't me. It was cost the college that, but I had to, be on the hook for it. And then of course, we're looking at our budgets. And so for to measure how well we're doing, we have a comparison. We have a cost per full-time student enrollment. So they take the number of students I have in all of those departments I told you about, and they take my costs and then they divide it by those number of students, and then they compare us against all the other departments in the college. Does that make sense? And then they're saying, how expensive are you relative to the number of students you're serving? And they have 2 versions of it. They have a with capital and without capital. The idea is capital is not really controllable by me. That's done by schedule. Anyway, so I'm just kind of give you an idea of how we use these in real life. And so then my boss can be like, out of 37 departments here at the college, you're number 26, you're kind of expensive. What are you doing to cut those costs, right? Or things like that. Well, if we're the business department and we're so good at managing business, then why are we 26 out of 32? That's part of it, right? Because part of my division is computers, and we see all this, but that cart in there, no other department on campus has a cart full of MacBook Pros. Just that cart of MacBook Pros cost me 60 grand. Licensing and we need Apple products because we can't really prepare people in computers without teaching them iOS and Windows, right? All right, so yes, so then I justify that, right? I say this is why our costs are a little bit higher. So this is just gonna, on your balance sheet, if you think about it, it's just gonna be your assets. Okay. So this is just a breakdown of what that we're buying this year. Yeah. And so all of this will lead into a budgeted balance sheet, which I didn't show. So that's all I have for this chapter for you until we do the guided problem on Friday. I know some of you will be dogging out because you'll be like, spring break, got to catch my flight to wherever you're going. Hey, try not to get caught in any college students gone wild videos over spring break, please. Be smart is all I'm saying. You guys are all like, I don't go wild. I'll probably just have a chance to read a book or something. I'm taking my granddaughters to the aquarium. That's as wild as I'm getting. So yeah. So have a great day. I'll see you on Friday. And I don't know, make good choices.